The most expensive decision in your investing life will not be a bad stock, a bad entry, or even a market crash. It will be the moment you bought something not because you understood it, but because you were afraid to be left behind. That moment has a name, and its price is far higher than money. Most investors think FOMO is emotional weakness, a momentary lapse, a mistake you can fix later. That belief is comforting and completely wrong. FOMO is not an emotion. It is a structural tax on long-term performance. It doesn't just make you enter late. It rewires how you think about opportunity, risk, and time. Here's the reality most people never confront. Markets do not punish ignorance first. They punish urgency. FOMO pushes you to act before clarity, before rules, before alignment. And once urgency enters your decision-making, everything else quietly collapses. Position sizing becomes aggressive. Risk tolerance becomes imaginary. Time horizon shrinks. Exit discipline disappears. From the outside, it looks like a single bad trade. From the inside, it's something far worse, a permanent downgrade of your decision system. Most investors calculate the cost of FOMO incorrectly. They look at price charts and say, "I bought too high." That's surface-level thinking. The real cost of FOMO compounds across 4 invisible layers. Miss one layer, and you'll never understand why returns stay mediocre, even when you're right sometimes. Let's break it down. Layer 1, the price cost, the only one people notice. This is the obvious part. You enter after parabolic moves, viral narratives, confirmation from crowds. Your margin of safety is gone before you click buy. But here's the uncomfortable truth. Price is rarely what destroys portfolios. Timing psychology does. Many investors buy high and still could survive if the deeper layers didn't activate. Unfortunately, they always do. Layer 2, the positioning cost, silent damage. FOMO never comes alone. It always brings oversizing with it. Why? Because FOMO convinces you this is a rare opportunity, a once-in-a-cycle moment, something you can't miss. So you don't buy a position, you bet. That changes everything. Now, a normal pullback feels like a threat. Volatility feels personal. Noise feels like information. You are no longer managing risk. You are defending a decision. And once defense replaces analysis, objectivity is gone. Layer 3, the time horizon collapse. This is where real damage begins. FOMO compresses time. Long-term investors suddenly check prices hourly. Swing traders suddenly believe in the project. Everyone suddenly changes strategy mid-trade. Why? Because FOMO doesn't ask, is this good over time? It asks, what if it runs without me? That question destroys patience, and patience is not a virtue in investing. It is infrastructure. Without it, you sell too early if you're right, you panic if you're wrong, you never let compounding work. This is how investors with good ideas end up with terrible results. Layer 4, the identity cost, the one that stays with you. This is the deepest layer and the most expensive. Repeated FOMO teaches your brain one lesson. I act under pressure. Over time, that becomes identity. You stop trusting, waiting, inactivity, uncertainty. You begin to associate doing nothing with missing out instead of with discipline. At this point, the market doesn't need to trick you anymore. Your own reflexes do the work. This is how FOMO turns from an event into a default behavior. 4. Naming the trap, urgency illusion. FOMO survives because it wears a disguise. It pretends to be opportunity, decisiveness, boldness, but its real name is urgency illusion. Urgency illusion makes you believe speed equals intelligence, action equals competence, hesitation equals weakness. Markets exploit this illusion relentlessly because markets don't reward speed. They reward alignment with reality over time. Urgency moves faster than understanding. and faster always pays a penalty. V. Silent pause. Let the viewer sit with this idea. If an opportunity truly fits your strategy, it will still fit tomorrow. If it disappears the moment you slow down, it was never yours to begin with. VIX reframing FOMO. Missing out is not a loss. Here's the reframe that changes everything. Missing out is information, not failure. Every opportunity you don't take defines your strategy, protects your capital, sharpens your filters. Professional investors miss most moves by design because their edge is not participation, it's selection. FOMO investors ask, why didn't I buy? Veteran investors ask, why would I buy? That single inversion separates amateurs from professionals. FOMO only exists when your rules are unclear. If you truly know what you're waiting for, why you're waiting, and what disqualifies a trade, then someone else's profit becomes irrelevant. FOMO is not about markets. It's about identity confusion. You are torn between who you said you were as an investor and who you feel pressured to become. Resolve that conflict and FOMO disappears, not because you resist it, but because it no longer makes sense. The market will offer you endless chances to abandon patience in exchange for excitement. It will celebrate speed, reward noise, amplify urgency. But wealth does not come from keeping up. It comes from staying aligned. Those who learn to miss out without emotional cost eventually stop missing anything that matters. Most investors believe compounding is fragile. They think it depends on perfect entries, brilliant predictions, catching the biggest winners. That belief is wrong. Compounding is not fragile. It is patient. What actually breaks compounding is not being wrong. It is interrupting the process. FOMO is interruption. Every FOMO-driven action introduces friction. You enter late, you exit early, you resize emotionally, you rotate constantly. Each interruption looks small, almost invisible. But compounding is multiplicative, not additive. Small disruptions don't add up. They multiply against you. Here is the math no one shows you. You don't lose compounding when you lose money. You lose compounding when you reset your process. And FOMO resets it over and over again. Every cycle has its legends. This is different. This changes everything. This time is the real one. FOMO feeds on novelty, but markets feed on repetition. Technologies change, instruments change, names change. Human behavior does not. The same emotional structure repeats. Early skepticism, slow adoption, explosive enthusiasm, narrative certainty, late-stage FOMO, collapse, or stagnation. Veteran investors don't avoid FOMO because they are disciplined. They avoid it because they have seen the pattern too many times. Once you internalize this, something strange happens. Urgency loses credibility. You realize, if this opportunity truly matters, it will exist within a broader pattern, and patterns do not require haste. They require positioning. FOMO convinces you that not acting is costly, but here's the inversion. The biggest opportunity cost is not missed upside. It is damaged decision quality. When you act out of FOMO, you lose optionality, flexibility, and clarity. You lock capital into fragile positions. You reduce your ability to act when real asymmetry appears. Professional investors obsess over optionality, not excitement. They want capital that can move, attention that is not hijacked, emotions that stay neutral. FOMO trades steal all three. So the true opportunity cost is not the trade you didn't take. It's the future trade you couldn't take because your capital, time, or psychology was already compromised. FOMO does not end when the trade ends. It leaves residue. If the trade works, you reinforce urgency. You mistake luck for validation. You raise future risk. If the trade fails, you feel behind. You chase harder. You lower standards. Either way, the system deteriorates. This is how FOMO becomes serial. One emotional decision demands another to compensate. One rushed entry demands another opportunity to make it back. One missed exit demands another bold move. This is not trading. This is emotional debt rollover. Markets are ruthless to investors who carry emotional debt. They extract interest relentlessly. You don't fight FOMO with willpower. Willpower is fragile. You eliminate FOMO with structure. Here are 3 filters veteran investors use, often unconsciously. Filter 1. Predefined disqualification. Before asking why to buy, define why you would not buy. If a setup violates even one disqualifier, it is dead on arrival. This removes debate. FOMO thrives in ambiguity. Disqualification kills ambiguity. Filter 2. Time-decoupled decisions. Any decision that cannot survive a night of sleep, a full trading session, a temporary pullback is not a decision. It's a reaction. Veteran investors deliberately delay execution to see if urgency fades. If urgency fades, clarity often remains. Filter 3. Identity alignment. Ask one question that cuts through everything. Is this decision consistent with the investor I claim to be? Not the outcome you want, not the profit you imagine. The identity you're building. FOMO always asks you to betray that identity, just this once. Professionals don't negotiate with identity. Let this settle. If you must rush to participate, you are not investing. You are reacting. Calm is a competitive advantage. In modern markets, information is abundant, speed is cheap, access is universal. What is rare is calm. Calm allows you to wait without anxiety, observe without attachment, act without urgency. This is why calm investors outperform, not because they know more, but because they lose less to themselves. FOMO is the tax paid by those who confuse motion with progress. If you feel FOMO, you are already late psychologically. Here is the final insight that closes the loop. FOMO is not a signal to act. It is proof you have lost positional advantage, not in price, but in mindset. Once you feel urgency, the asymmetric edge is gone. The correct response to FOMO is not courage. It is withdrawal. Professionals don't enter when emotions peak. They enter when interest fades and clarity remains. Once you see this, FOMO stops feeling tempting. It starts feeling diagnostic. The investor who wins quietly. The market will always reward someone loudly, someone fast, someone bold. But long-term wealth accumulates quietly, in portfolios untouched by urgency, decisions untouched by crowds, and identities untouched by fear. You don't build wealth by catching everything. You build it by knowing exactly what you are willing to let go.